Hi, everybody. Thank you so much for joining the Jewish Community Foundation this morning on our Professional Advisor Network webinar. I'm going to pass the baton over to Jenny Udanin just to welcome you all.
Hi, I'm Jenny Udanin. I'm the chairperson of the Professional Advisor Network at the Jewish Community Foundation. As you may know, our goal is to provide a networking and educational forum to the professional advisors in our community. And we're trying to fulfill that even in these difficult times. So this is the second of our Lunch and Learn seminars. And I want to thank our presenters and the professional staff of the Jewish Community Foundation for putting this together. So with that, I turn the floor over to our presenters, Steve Fishman and Michael Schechner, our insurance gurus.
Thank you, Jenny. Welcome, everybody, and thank you for taking the time to hear about developments in the life insurance industry. I'm going to jump right in. We have a lot of material to cover today. So one of the burning questions that people are asking, and I'm not going to suggest that they're ringing off the hook, but people are asking if somebody does pass away from a COVID illness, a COVID-19 coronavirus illness, does my life insurance policy cover me, or will the proceeds get payable to my beneficiaries? The answer is absolutely yes. Policies that were issued, whether it was 20 years ago or 15 years ago or 10 years ago or 5 years ago, absolutely, there are no exclusions for any pandemics. So there does not need to be any worry for any type of exclusion for that. Now, having said that, Michael and I, later in the program, we are going to be discussing how life insurance companies are handling the issue of new policies going forward and what kind of steps they are taking to issue new policies and how they need to be careful and also assure people when they buy policies that they are covered going forward. So we will cover that in the upcoming few minutes. Moving on to reconnecting and reassuring and reviewing. I think that we covered that just a little bit in the last week's program because Gary Botwinick and Anita Siegel, two fine attorneys, talked about what they're doing in their practices and how attorneys are speaking with their clients during these uncertain times. Well, all professional practices, CPAs, insurance professionals, investment professionals, need to be in contact with their clients, not just during uncertain economic markets, and not certainly just during these particular times, but we know our clients are speaking to their professionals because they're talking to them about the Paycheck Protection Program. They're talking to their attorneys about personal and corporate planning. They're talking to their investment advisors for sure about the economic markets. So we're not just living during uncertain times right now. We're definitely living in volatile times and complex times, and what I would call ambiguous times as well. And just as an aside, there is some leadership and management training known as VUCA, V-U-C-A, which the acronym stands for volatile, uncertain, complex, and ambiguous. So anybody interested can Google that after the program. And there's some management and leadership training that large corporations send their executives to talk about how to succeed in a chaotic world. But getting back to what are we doing in the insurance industry to reconnect and reassure our clients, here's what we're doing. And here's what I believe that I know Michael and I have discussed it and other people in professional practices are doing. We are talking to our clients about their life insurance policies. And if they have cash value policies, we're reminding them that certainly if those policies are cash value type, fixed type of life insurance policies, fixed meaning whole life, or fixed universal life, meaning not variable life, because variable life policies are equity-based and tied to the stock market. So if they are fixed life insurance type, whole life and fixed universal life, those policies not only have not gone down, but those policies are still increasing in value, even during these economic conditions. Even during slow economic growth, they are still increasing in value. So we are connecting with our clients and talking about that as well. So during these economic conditions, things are still working. Stay-at-home orders, social distancing, what's happening? We're talking to our clients about their anxiety. What are they experiencing with their family, with their friends? How are things going in their business? So we're trying to discuss with people and email them and speak to them not just about policy performance, but talk about things like term insurance policy expirations. Do their policies still meet their goals that they've intended? When was the last time they spoke to their legal professional? And when was the last time that they reviewed their documents? I mean, frankly, people are spending a whole lot of time at home. It's not a terrible idea to pull their policies out and have a conversation with your insurance professional, have a conversation with your accountant or your tax attorney, and start reviewing documents and even make a phone call. It's not a bad idea to talk about beneficiary designations. It's not a bad idea if you have insurance and your business is changing and revenues are down and you have a shareholders agreement and your business was once worth X and now your business is worth maybe 2/3 of X or even 50% of X. I'm not necessarily advocating that you eliminate insurance just because of this particular event, because hopefully things will turn around, but it's not a bad idea to have a conversation with your professionals and potentially have a conversation about maybe moving insurance out of corporate setting, out of a corporate ownership, and maybe move it into a personal ownership, if in fact your personal finances may be better than what your corporate revenues or your corporate income may look like right now. So it's worth having a conversation about the ownership style of your life insurance right now. Are your parents okay? We all have heard what's going on in nursing homes. And if you're a 40 or 50-year-old client, if we're reaching out to a 40 or 50-year-old client, and those parents are, the parents of our clients are older, we should be having conversation with our clients about how their parents are doing. And if there's a long-term care conversation that needs to be had, then we need to have it. And so I think when we reach out to clients, as I've spoken to colleagues who are in the investment space, you don't want your client to be calling you first as an investment professional. You want to be calling them first. So not being in that field, I've taken that advice from colleagues and friends that are in that space and reach out to clients first to see, is there anything that I can do or anything we can do to try to help them calm their fears and their anxieties about what's going on in their business. And frankly, when clients do get bills for their life insurance, sometimes they're small, sometimes they're medium in size, and sometimes they're quite large. We need to be able to communicate with them what their options are in terms of flexibility. And the next section that we're going to get to is talking about flexibility. But before I do, there is a conversation and there is a deeper conversation you can have certainly with corporate clients, because many times corporate clients do get the request, if they have a line of credit, that the bank that provides the line of credit suggests that there's a collateral assignment on a life insurance policy. And then 2 years later, 4 years later, or 8 years later, the bank has never even said one word about that life insurance policy that they requested that you maintain on the shareholder in that business. Well, if a number of years go by and the bank hasn't even brought it up, you might want to suggest to your client that if you're a CPA or even an attorney, to call the life insurance person or even call the bank and say, is that life insurance still even needed? And if that if the bank says, you know what, you've done a great job managing your line of credit and we don't really have any concern about that collateral assignment, maybe you can ask the bank to release that collateral assignment. So that's a good question to ask clients, and not necessarily needing to get rid of that insurance, but maybe take that insurance over personally or eliminate it if that's what's necessary. So you're helping a client, and the best possible thing that any insurance professional can have at the end of a meeting is a client saying, you know what, that's a very good question. I'm going to go call my CPA, or that's a very good question. I'm going to go call my attorney, or that's a very good question. I'm going to go call my banker. Thanks for bringing that up. So at the end of the day, reaching out to clients, that's what we're hoping to accomplish. And just to finish up on this one section, grace periods, before I turn over the program to Michael, is grace period extensions. And just going to talk about New York and New Jersey for now. Both states, both governors, Murphy and Cuomo, have issued executive orders. So first we're going to talk about New Jersey, and then we're going to talk about New York. So I'm not going to get deep into the weeds on the what the executive orders say, other than to say there's one very large distinction between the two, in that the New York executive order requires that you demonstrate financial hardship. So I know that the first slide talks about New Jersey, but essentially what they're allowing is requiring that the life insurance companies give you 90 days extension on your grace period. Typically a life insurance company, and statutorily, you have a 30-day grace period for the a life insurance premium to be due and payable. And during that 30-day period, you have insurance coverage. So if your premium is due April 25th, you have until May 26th, actually have a 31-day grace period. And you have 30 days under which you are still covered for that period after the due date. And these executive orders are basically saying you have 90 days. Now, having said that, nothing in life is necessarily automatic. So I would say that even though the executive orders say that there's this 90-day extension, if you are having, or clients are having any issues related to life insurance, and of course the executive orders speak to auto and home, and they specifically say they do not apply to health insurance. I know the New Jersey order specifically states that it does not apply to health insurance programs because those are federally mandated, not state mandated. So what I would say is that if any client reaches out to you and indicates that they're having any problem, that you would reach out to the carrier and state your case and find out what their specific protocol is for remedy on your particular policy. And just make the note that specifically you have, in New York, you have to demonstrate financial hardship, and there is 90 days. And one other point before I turn it over to Michael is that the executive orders are allowing up to 12 months to repay the back premium that you might have missed. And so they're not going to try to burden you to pay the back premium plus current premium all in 1 or 2 month period. So you will get 12 months. And with that, I'm going to turn it over to Michael.
Thank you, Steve. So first, I hope everybody is healthy and well, you and your families. Steve, that's a good positioning of what's going on with existing policies. I'd like to turn now to underwriting of new coverages and what's going on for new policies. And I guess the question really is the insurance industry still open for business? And the answer very much is yes, we are. Flexibility has become the word of the day. Carriers have historically been very slow to adopt new technologies, but we are seeing a great deal of change in the underwriting methodology now, and carriers are moving very quickly. So what do I mean by this? First, face-to-face meetings. A face-to-face meeting is no longer a necessary part of the process. We've long dealt with emailing of forms, but generally we've had to get a wet signature from a client, and then we can email it back and forth to the carrier. Carriers are now widely accepting e-signature, DocuSign, and similar technologies for applications, for delivery forms, for other documents, and so on. I know of at least one carrier that is requiring a face-to-face, what I'll say is an interaction. It can be a Zoom call. I guess they want to make sure there really is a person at the other end, but otherwise it can be done without direct face-to-face interaction. One item we do need to be careful of, though, in this environment is the location where a person is. Insurance is regulated state to state, and different states have different forms and different requirements. As an example, I have one client, a young couple with young children. They live in Brooklyn, and when this whole thing started, they took off and went to her parents' home in Maryland. We now have some forms to sign. They're New York residents, but they're physically in Maryland. So it's not hard to do. We just have to know to work around issues like that. No one is looking for any more face-to-face contact today than is necessary. And I'd say this is especially true when we talk about medical exams and parameds and blood tests and urine tests. These have long been a key element in the underwriting of a new policy, and we're seeing carriers move to what is known as fluidless underwriting. That is to say, no blood tests, no urine, no fluids necessary. In the past, carriers have wanted their own tests and have not been willing to accept a doctor's records exclusively. And there are several reasons for this. One is chain of custody. The carrier wants to be sure that the tests, the results, have not in any way been tampered with, or I'll say edited, to take out something that may not look as good for the client. Second reason is timing. If the test is done for the insurance exam, for the insurance policy, we know the information is current. And then there are some tests that are done by insurance carriers that historically are not done generally by a doctor. And the three primary ones here are tests for nicotine, tests for cocaine, and tests for HIV. So the carrier has in the past wanted their own tests. We are now seeing carriers going to, as I say, fluidless underwriting. They will accept a doctor's exam as long as there was full blood tests, usually within 12 months. Some carriers may go a little bit longer, some may go a little bit less. But the key thing we're seeing are insurance policies no longer requiring the paramedical exam in many situations. If we take fluidless underwriting one step further, we get to what's known as algorithmic underwriting, or its very close cousin, accelerated underwriting. Algorithmic underwriting works off predictive analytics, or said differently, sometimes good enough is good enough. If a carrier can gather enough information to get an accurate underwriting read on, and I'll make up the number for illustration, for 97% of their applications, that's good enough. If the other 3% are wrong, it's not worth the time, effort, and cost to get everyone exactly perfect. Algorithmic underwriting is driven in large measure by 6 key pieces of information that a carrier can lay their hands on almost instantly. The first is demographics. We know the gender, we know the birthday, we know smoking status, we know some basic information about the applicant. The second piece is a prescription database. Not everyone knows there is a prescription database that all pharmacists in the country subscribe to. The primary goal is to make sure that a person doesn't fill one prescription to one pharmacy, then a different prescription at a different pharmacy, and end up with a bad drug interaction. But insurance carriers also have access to this information. So in real time, they can find out any prescriptions that a person has filled in the last several years. And that's a key piece to the predictive analytics. The third is what's known as MIB, the Medical Information Bureau. This is a database and information shared among insurance carriers that will tell one carrier if someone has applied for insurance recently with another carrier. If someone has applied to 5 carriers in the last 2 years and been rejected by all of them, that's obviously going to be a red flag. The fourth piece of information is an in-force report. What insurance is already in place on this person? The fifth is a motor vehicle report, again, available almost instantly, get driving record and so on. And the last piece for these algorithmic underwriting rules is what are known as knockout questions. So these are a series of questions, and they're a little bit different for each carrier that will make a person either eligible or ineligible for these underwriting programs. For example, is there a history of cancer or heart disease or kidney disease in your family prior to age 60? Or have you been treated for alcohol abuse or drug dependency in the last 10 years? Series of questions. If the answer is yes, then you have to go into regular underwriting. It doesn't mean no. Algorithmic underwriting is similar, I think, to early decision at college for those of us that have been through the college application process. The answer is almost never no. Rather, the answer is you're approved or you're kicked back into regular underwriting. The primary advantage of these programs and the algorithmic underwriting is speed. There's no paramedic exam, there's no fluid testing, there are no doctor's reports. The information that's used is available in real time, and an underwriting decision can be had in a day or two. As the artificial intelligence, as the carriers get better, this is probably going to drop to a matter of minutes. In some cases, for smaller amounts, it's actually available instantaneously. The industry was moving here anyway, but if you would ask someone, if you would ask me or Steve or someone about this 3 months ago, we would have said that this is good, the algorithmic underwriting, for young people up to age 60, for people that are healthy, dollar amounts up to about $1 million. But in the age of social distancing, COVID-19, we're seeing carriers expand these programs to higher face amounts, and in quite a few cases, up to $2 or $3 million for people that are not perfectly healthy, though you can't have a serious impairment and you're still eligible. I want to talk for a minute about cover letters as well, because this comes into play quite a bit in this day and age as well. Cover letters to applications have historically been used by insurance professionals to provide details and additional information for which there's no real place on an application. The information is used by the underwriter to get a better understanding of the insured, of the circumstances, of the need for the insurance. For an application that is not eligible for algorithmic underwriting, yet is still a fluid list application, this is additional information that will let the underwriter get much more comfortable with making a multi-million-dollar decision with less information than they're used to having. So it's a way of elaborating on necessary information to take the place of information that we have to do away with. And then we also comment here on field underwriting. Field underwriting refers to the insurance professional getting a more complete picture of a client prior to submitting the application. So it both helps to manage expectation, but it also assures a better selection of carrier and oftentimes a better underwriting result. For example, I talked about the knockout question, a history of heart disease in a parent. If someone has a parent who had a heart attack at age, let's say 63, then it matters whether the knockout question says a history of heart disease prior to age 60 or prior to age 65. So that level of detailed field underwriting takes on even more importance. And then the last piece in terms of flexibility deals with medical records and attending physician statements. Doctors' offices these days are either very, very busy, or there are quite a few that are closed because the doctors are either not working from the office or they're not involved in COVID and don't want to be a source of the spread. So again, flexibility matters, and we're seeing carriers look to new ways of obtaining this information. And many carriers have become willing to actively retrieve medical records rather than wait for a doctor's office or a service to send them. And specifically what happens is if there was a good patient portal, RWJ Barnabas has a good portal for their patients. Summit Medical has a very good portal as well. The client will give the insurance carrier access information, login information. The carrier will go to the patient portal, take the information that they're after, then a day or two later, they tell the insured, we have what we need, and the insured will go in and change their password, which will eliminate access. But the carrier is not given blanket access forever. You have access for a day or two, then the password is changed, and access goes away. And in that way, we can eliminate waiting for a doctor's office to send information. So what happens if someone has had COVID-19 or has been exposed to COVID-19? Are they still eligible for policies? And the answer is certainly, but what we are seeing is a postponement of an offer being made. Generally, the postponement is for 30 days after the last symptom has abated, but it will depend on how severe the case was and whether there are any complicating factors. Does the person have a history of respiratory disease, for example, in which case we may have to wait a little bit longer. If someone has just been exposed but has not shown any symptoms, again, postponement is the most likely result, but more detail is needed. Now this gets back again to the cover letter. Is the person an ER doctor or an ER nurse and has been exposed, or do they work next to someone who showed symptoms, left work, a week later tested positive, but the client has shown no symptoms yet. And finally, before I turn it back to Steve for a little more, I want to talk about international travel. Again, if somebody has traveled internationally or has plans to travel internationally, we're looking again into postponement, and usually it's the person has to be back in the United States for 30 days. Now, if someone has traveled, that's easy. But if someone has upcoming travel, question, and this is true not just today, but always, what is upcoming travel? Some of it is quite clear. If someone says to me, there's one flight a day left from the New York area to Rome, and I'm going on May 13th for business, so I'll be there for 4 days, clearly that has to be disclosed. If someone says, I've always dreamed of visiting Japan, and I hope to go in the next year or two, that's not planned international travel. But there's a lot of area in between. I think of one person I know, 2 of his 4 children live in Israel, which means all 3 of his toddler grandchildren are in Israel. He has an apartment in Jerusalem that he bought 3 years ago. It's hard to say this guy is not going back to Israel, but he has no specific plans. That would probably be a postponement until the world settles down and we know a little better what's going on. But in any case, it needs to be disclosed and explained. We're back to the cover letter. We're back to making sure that there are no surprises to the carrier, and even more important, making sure that the application is accurate, because otherwise we end up with a possible fraudulent situation and a denial of coverage. So everything needs to always be explained. Steve, back to you for some more on underwriting.
Thank you, Michael. So we're going to get into what are the insurance companies doing right now. And on the screen, you'll see right now, most insurance companies are not writing people that are age 70 and above. Now, there are a few companies and that will still entertain applications for people that are 70 and above. We've gotten some notifications that some companies have just outright shut down the process. If people were in underwriting, applications received, they were done. They just decided, you know what, we're going to just postpone and wait. So right now, 70 and above, many insurance companies they just want to wait. And however, there's 2 insurance companies, maybe there's a third one out there, but right now there's 2 major insurance companies that are still underwriting, but they're being very, very careful. When I say very careful, what that means is that they are underwriting 70 and above, but you better be a standard risk or better, meaning no real medical impairments. And a medical impairment, if you have controlled hypertension and you're 72, that's okay. Because controlled hypertension, they don't really view as a significant or even a problematic medical impairment. So controlled hypertension is not a big deal. So that would be something that would be considered a standard risk or better. If you're 60 and above and you have a mild impairment, those gates are open. Those applications are being processed. But again, life insurance companies are being very careful. I can tell you that what the insurance companies will not be underwriting, most likely not be underwriting right now, if you're 60 and above, typically are the big 4. These are the medical impairments that they're trying to stay away from right now during the COVID era. And those are coronary issues, people with significant coronary issues, people that are still within a 5-year post-cancer treatment, post-cancer treatment scenario, and people obviously with lung and pulmonary and respiratory issues, and people that have diabetes under poor control. And that's important. So diabetes isn't necessarily in and of itself a problem. It depends on onset, control, and then comorbidity issues like weight and heart. So diabetes in and of itself isn't a major issue. It just really depends. So what I'm referencing right now is diabetes under poor control or just not under good control. So 60 and above, not really a problem unless you're under one of those 4 areas. The other thing that's really unfortunate is that many insurance companies have what they call table shaving or table reduction programs. And the word table really refers to the insurance company's ability to take people with mild and moderate and sometimes more than moderate impairments, psoriatic arthritis or diabetes not under really good control, and people that have comorbidity issues, weight issues, build issues, in addition to a heart issue or a diabetes issue, but still plug them into a table shaving or table reduction program and still be able to say, you know what, even though they've got these medical issues or impairments, we're still going to give them a standard rate because they're not so bad that we have to give them an offer that we would otherwise not be comfortable with. So those table shaves have, for the most part, I've seen a lot of insurance companies saying, right now, we're not going to be offering table shaving or table reduction programs because those are ways in which the insurance companies can be competitive. Those are ways in which the insurance professional can offer an amazing offer or design and premium to a client. And so insurance companies are moving away from that right now. Delivery requirements. What a delivery requirement is where you've been approved and now all of a sudden the policy is being delivered to you. Well, maybe 3 months have gone by the time that it took for the medical records to reach for the medical records from your physician to reach the insurance company. Well, that's a long time from the time you actually submitted the application to the time that you've gotten the formal approval. Well, how does the insurance company know that you haven't been exposed to COVID? How does the insurance company know that you haven't been diagnosed with blood pressure problems or anxiety or any other new thing? So typically it's not uncommon for the insurance company to ask you to sign a good health statement. So you'll see on the screen that the insurance companies, for the most part right now, are asking for you to sign a statement, I have not been exposed to COVID to the best of my knowledge. Now, if you're a frontline worker, you can't sign that statement. But if you've been home, and like myself or people that we know on the line that have been working from home, you can make that statement, I have not been exposed to COVID. But they're also asking you to sign a good health statement, not only saying that you haven't been exposed to COVID to the best of your knowledge, but you're not making international travel. And I'll just finish up before I turn it over to Michael to say that exclusions and product limitations, and the exclusions are, just to give you a taste of what's going on, one insurance company decided we're not going to be in the 30-year term insurance business any longer. So, but the same week that the one insurance company, who happens to have a nice home office in the middle of Newark, decided that they weren't going to be in the 30-year term insurance business, another insurance company said that we're now introducing 35 and 40-year term. So you might think to yourself as an insurance professional or somebody on this line saying, one insurance company doesn't want to be in the 30-year term insurance business while another insurance company is introducing 35 and 40-year term. That doesn't make any sense. But if you really dig into the weeds, which I'm not going to dig into the weeds, but what's interesting is that the company that is leaving the 30-year term insurance business, one of the reasons they're doing it is because these are not just life insurance companies. These are financial services and financial behemoths. And the company that's leaving the 30-year term insurance business has a significant pension risk transfer business, which means that they are in not just the mortality business, but they are also in the longevity business. They have a significant pension risk transfer business, means they're in the annuity business, which means they're in the longevity business. So they have to manage risk on people dying too soon and people living too long. And the other company is really just in the mortality business. And the company that introduced 35 and 40-year term is also a Japanese company. So you've got one company that's American, you've got one company that's Japanese. The Japanese company has made a significant investment in other blocks of business by buying 2 other insurance companies that have significant blocks of term life insurance business. So that's the dichotomy between one company being out of the 30-year term insurance business and one company introducing 35 and 40. And I'll finish up by mentioning one thing about stacking of limits. Going back to algorithmic underwriting, Michael introduced how you can get insurance without fluids. Well, What if you want $5 million of life insurance, but the algorithmic underwriting programs can say you can only get 3? Stacking means if you go to one insurance company and get 3 million without fluids, you can go to 2 other insurance companies and get 1 million from company B. You get 3 million from company A, 1 million from company B, and another 1 million from company C, all the while you haven't provided any blood or urine. So there is a way in which you can stack your insurance policies to acquire a larger amount of coverage without going through a paramedical examination to provide blood and urine. The 2-year incontestability provision is the same type of thing, which means every life insurance policy is issued with a 2-year incontestability, which means don't commit fraud. First of all, it's very difficult because Michael talked about prescription databases, medical information bureaus, driving motor vehicle checks. Very hard, but if you can, people out there try to get away with things, which includes suicide clause. So if you've been exposed to COVID, if you're a frontline worker, you have to disclose it, and the insurance companies will figure it out. So back to you, Michael.
Hey, thanks, Steve. We're running a bit long, so I'm going to give the last section here, what happens next, try and speed this up a little bit. Let me say COVID-19 is clearly a major event for life insurance carriers, but it's a shock to how business is done, not a shock to the business itself. That is to say, at the end of 2019, carriers were about as well capitalized as they ever have been. Now, in no way do I want to diminish the significance of the number of deaths that we've seen from this, because it's a terrible, terrible thing. But the life insurance industry can handle this. It's not going to be a financial impairment to the industry. Some carriers will be hit more than others, obviously, but overall, it's not a real issue to the overall health of the business. The bigger issue going forward is really the long-term continued low interest rates, and indeed the further depression on long-term interest rates that we've seen as a result of the economic halt. The issue here is carriers don't have good places to put their money. And that's the real problem in the long run. Life insurance carriers receive approximately, in total, $10 billion every week in insurance premiums, and they need somewhere to put this. Now, the extended grace periods may push this out a little bit, but the bottom line is there's a huge amount of money that these carriers need to find homes for. With interest rates as low as they are, carriers are making less money on their investments, and as a result, they're going to need to find profit and find income other places. So premiums are going to go up. We already have one company raising premiums as of May 1, another one announced as of June 1. Interest-sensitive products, which is just about every permanent form of insurance, which is what we use mostly for long-term estate planning issues, premiums will be going up, if not immediately, then during the second half of the year. I did see one carrier come back and say they're looking at probably a 12 to 15% premium increase by the end of the year. Again, driven by interest rates, not by COVID-19 claims. So where does all of this, and at the same time, there will be a restriction in products available because of the low interest rates. So where does all of this mean? Where does it take us? At last week's session, Gary and Anita talked about how attorneys can continue to work with their clients on estate plans in an age of social distancing. Within the life insurance business, which is also an integral part to many, if not most, estate plans, we also have some changes that have to be done, but the current environment does not, should not mean that insurance plans have to get put on hold. Carriers are learning to be flexible, underwriting is continued, and as we said in the title of the talk, this time is both an opportunity as well as a challenge. For younger, healthier people, it's a great opportunity to get insurance in a speedy way and sometimes with limited underwriting. For some, the older people, people with medical challenges, as Steve said, it's more the challenge and it's actually going to be harder. But there is still, the industry is still open. So on behalf of Steve and Jenny and all of us, thank you everyone for listening. I think we have some time for questions. Yafa, I'll turn it back to you. I think as to how we do that, everyone just stay safe and wash your hands.
Hi, everybody. Thank you so much, Steve and Michael, for this presentation. There's a Q&A feature on the top. If you have any questions, if you can please ask them of Steve and Michael, and they will be answering. We also have a short poll that we're going to put up at the same time as Q&A. If you have a few seconds, it's only 2 questions to take this poll. It will help us with our planning. Everything was so clear. I don't see any questions.
Well,
All right, we're going to wait another 1 minute to see if any Q&As come in. If there's anything that you guys want to add, now's the time.
Thank you for being here, and stay healthy, and take care of your families.
Oh, the Q&A. Steve, do you want to take it? It says, what impact will delayed premiums have on, but the question wasn't finished, maybe on the results?
What impact
Oh, the
delayed-
illustrations, sorry. What impact will delayed premiums have on the illustrations?
That's a good question. So that's going to impact universal life. So what impact does delayed premiums have on an illustration? So that really reverts to how is it going to impact policy performance or guarantees. So different carriers handle that differently. Some companies will take a premium that's paid 2 weeks after the due date and apply it as if it had been received on the due date. And some companies will not do that. And unfortunately, I don't have an answer for every specific carrier. What I would do, however, is make sure that if in fact you are making a premium after the due date and you do have a universal life policy that's based with that's built on a chassis with a guarantee, GUL, a guaranteed universal life, that you call the carrier and specifically ask, especially during this COVID-19 period, that you want to ask if they're going to be crediting that premium payment. If it's 2 weeks late or 3 months late, ask how they're going to be applying that payment. Now, if they may ask you to try to prove if that payment was made, if you were actually suffering financial hardship due to the COVID-19 crisis, or if it was just late due to, if it was 2 weeks late, then you might not be able to prove that it was COVID related, or maybe you will be able to. So that I believe that would be company by company basis, but it will have an impact.
Thanks, Steve. We have another question.
Michael, go ahead.
okay. Have clients been buying new policies? Have we seen activity slow down or speed up? The answer is people are still buying policies. I don't want this to sound grim. The whole issue has brought mortality and individual planning back into the fore. Many people are now thinking about it more than they used to. It is acting as a bit of a spur for some people to take action that they've been delaying otherwise. I would say insurance that is needed, if you will, we're seeing probably a kick up in activity. For the more discretionary purchase, people are holding their cash at the moment. So it's both speeded up and slowed down depending on the situation.
Okay, great. Thank you so much, everybody, for joining us. If you can just take a minute to answer the poll, that would be really appreciated. Please stay safe and stay healthy. And thanks again to our speakers.